The government in Budget 2020 has used Section 4(2) of the FRBM Act that provides for a trigger mechanism for a deviation from the estimated fiscal deficit on account of structural reforms. Consequently, in FY20 as well as in FY21, there is a deviation from the fiscal consolidation roadmap. But the moot question is, how credible are the revenue numbers of FY20 and FY21? Let's do a three-point analysis of what is the quality of expenditure in these 2 years that can really make an impact on the ground. 1. Fiscal deficit slips to 3.8%. Well, fiscal slippage is largely due to the SOPs in the form of corporate tax cuts given in September 2019 and tardy tax collections. If one looks at the revenue receipt based on the actual collection numbers up to December 2019, 38% of the revised figure for FY20 revenue estimates will have to be collected in the remaining months of FY20. Now, in fact, the assumption of 18.3% growth in income tax in FY20 looks ambitious. For non-tax revenue, 30% of the budgeted collection will have to be garnered in the remaining quarter as well. If one looks at the disinvestment receipt, the point becomes clearer. The government so far has garnered about 18,000 crore rupees from disinvestment, whereas the revised target for FY20 now stands at 65,000 crores. Now that leaves with the tall task of mobilizing about 47,000 crore rupees in the remaining 2 months. Now turning now to FY21, the fiscal deficit to GDP has been pegged at 3.5% of the GDP and the nominal GDP growth assumption is 10%. Seen in this context, most of the tax revenue growth assumptions are not too way off the mark. However, if there is a shortfall in the income tax collection in FY20, the asking rate may be much higher than what is projected right now. 2. The devil lies in the non-tax revenue assumptions. In FY20, as against the target of 1.05 lakh crore rupees, the government has so far garnered about 18,000 crore rupees by way of disinvestment, and it has put a very ambitious target of 2.1 lakh crore rupees under this head in FY21, riding on the hopes of monetizing LIC, which has to be first converted into a company from a corporation, and the exercise may not get completed in a hurry. Now, the numbers also factor in the 36% increase in dividend from PSUs and 125% increase in revenue from the telecom services. While revenue assumptions on the non-tax side are also lofty, let us really focus on the quality of expenditure, which is key to taking the economy out of the current slowdown. Now, in FY20, the growth in overall expenditure was led predominantly by the revenue expenditure. Now, the key driver herein was the agriculture sector in the form of PM Kisan. Now, in FY21, the quality of expenditure assumes quite a bigger importance. Now, we argue that with the capacity utilization as indicated by RBI survey shows a decline in Q1 FY20 and the survey showing fewer new orders received in Q1, marking the third consecutive quarter of decline in new orders. A mere tax cut will not encourage corporates to invest really. 3. So will the big budget also fill in the gap with the requisite capital expenditure as well? While FY21 RE shows a higher growth in capital expenditure than revenue expenditure, however, if one really looks at the resources of the public sector enterprises that has supplemented government's efforts so far, the aggregate figure is actually lower. So the first budget of the new decade is really dotted with numbers that leaves us more questions than answers and is also unlikely to decisively lift the pall of gloom from the economy and the markets.